All right, let's talk about how to be a successful real estate investor in 2025. So the first thing we need to we need to wrap our minds around is higher interest rates. This is the new norm, at least for right now. Let's look at this chart. I'm going to blow this up a little bit so we can see it. Listen, we have definitely gotten spoiled around here, around this 4%. And then COVID, and we dropped down here, and we were loving the 2s, the 3%. It made buying real estate really, really easy. As a matter of fact, you could probably cover up a lot of mistakes with a super low interest rate. But if you look historically, 6 is around where it was for quite some time. This is the financial crisis here, the great financial crisis, and you see it come down. Here we are. We're probably going to be here for a little bit while. It's just a perfect storm because we still have high demand for properties. We still have some inflation in the market, so it's probably going to stay here right now. We've not gotten any signals that the Fed is going to lower rates, and essentially mortgage rates follow what the Fed says. So what this means is, obviously, there's going to be a little bit less cash flow, which is going to squeeze your margins. And so what you need to be doing, or what you need to be thinking about is, if you want to be a successful real estate investor in 2025, you need to think about, hey, are there deals that I can do that are seller financing, or negotiate better deals with motivated sellers? Now, one way that you can do this, one way that I've seen investors do this very successfully, is building relationships with realtors, because realtors they're typically the first person that gets called, and the people, sellers are like, hey, can I sell my property? The realtor will go look at it and they'll say, oh, well, you need to do this, 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 and this to the property. It's got, some rotten wood and peeling paint. And they'll say, well, I don't really have the money for that. That's when the agent is thinking, well, I can't list it on the retail market. Do I know an investor, somebody who will buy it as is, and I can still be the seller's agent? These are the people you should be developing relationships with. Them and wholesalers. I would say them, wholesalers, and then RIA meetings, getting to meet as many real estate investors as possible. Interest rates are going to remain high for quite some time, at least through 2025. So these are some of the ways that you're just going to need to get a little bit creative. So what we have seen is remote work is tending to, it's just kind of a part of everyday life. And so what happens are the migration patterns shifted to these remote areas. It's not all in the metropolitan areas, right? So if you have a job in Atlanta, they may not require you to come in 5 days a week into the office. Some aren't. Like, as a matter of fact, we have a lot of remote workers. We have, I want to say, somewhere around 600 or 700 team members, people on our team, and a lot of them are remote. We have international team members. We have local team members. Some of them are working remote. Some of them work in an office like I do. It's really up to them. So this means that suburban and secondary markets will continue to grow. This is just what we're seeing. There are some companies that are saying, hey, back to work. I know Amazon recently said 5 days a week back to work, but a lot of companies are not. They've figured out how to work with people being remote. And so this is what I think about. I think about investing in mid-tier suburban markets, and where you've got strong job market and quality of life. Raleigh, Boise. I know people who have moved to these areas because their job will allow them to move anywhere. I've known people who've moved from the West Coast to South Carolina or to Florida or to Texas. I've known people they're moving all over the place because they're not necessarily tied down to the location of their job anymore. And so what this does is it kind of opens up the markets for you to look at and say, well, what's a market I would like to invest in because it has a good quality of life and people may be moving there. I just named a couple: Raleigh, Boise. Also, rising demand for affordable housing. This is going to continue. This is going to be a trend that's going to continue. The median cost of a house now in the U.S. is around $430,000, which is incredibly expensive for people just graduating. It's like my son, like just graduating, $430,000 house. I don't think so, right? You're going to have a 20%, or you don't have to have 20%, but you're going to have a big chunk saved to put down on that property. And then with 6%, 7%, 8% interest rates, it's going to probably eat that affordability away. And so there's going to continue to be demand for rental. So this is good news for you if you want to buy rental properties. And that means a lot of people are going to be looking in this $1,000 to $2,000 a month range. This is affordable housing. This is going to be really tough for people to find. Now, the challenge is when you're buying property, you've got elevated expenses, right? Because things are more expensive now. So that means that if it costs you more to keep the house up, it costs you more to own that property, to service the debt, for insurance. There's all kinds of things that you have to consider. Then what people typically do is pass that on to their residents. What we've seen over the past year and a half or so is kind of a stabilization of rental rates not rising as high, so they're kind of normalizing. But if you can find something you can provide $1,000 to $2,000 a month, that is going to be phenomenal. There's going to be a high demand for those types of properties. That means that you're going to really need to look C-class areas. Wouldn't necessarily say properties. I'd say C-class areas. And you're going to need to look in those types of areas to find more affordable housing. And C-class, there's A-class, B-class, and C-class is really working class people. And they're just looking for a good 3-bedroom, 2-bath property, 1,500 square feet. And, they're just great residents. And so I would look for C-class properties if you want to stick in that $1,000 to $2,000 range. And you want to do it in markets that are that have strong rent demand, obviously. So think about this. Short-term rentals there's more regulation. There's all kinds of things going on with short-term rentals. Also, it's a more difficult investment. I know people who are doing well at it, and they've committed to the hospitality business, and that's what it is. And so, but you do have cities that are imposing stricter rules. We know this. We know New York City has imposed some really strict rules. There's other cities that also do this. I know downtown Nashville has done this for a long, long time. It used to be the Wild Wild West. It's not so much anymore, and I think more and more cities are figuring out, hey, we're going to be losing tax dollars, and we need to figure out how to help hotels still rent rooms, and that usually means there's going to be some more regulation with short-term rentals. So this means reduced profitability, increased risk. What if something changes in your market? What if they just shut you down? Doesn't happen often, but it could happen. And so strategy would just be focused on long-term or mid-term rentals. I'd say long-term probably is your best bet. Again, it's really interesting because short-term rentals, it's like there's more reward, but there's also more risk. There's more reward, but there's also more work involved. There's a lot more work. Maybe I'll do a video maybe I'll bring somebody on here and just interview them, somebody who's run both, who's had 100 unit portfolio of single family long-term, and then they've migrated a portion of those to short-term, and get them to talk about the difference between the two, because it is a big difference. So top 5 opportunities in 2025, I think value add properties obviously is what we want to go after. If we know rates are high, if we know demand is high, it's going to be difficult to buy something turnkey and really make it make sense. So maybe properties that need some repairs, cosmetic upgrades. I would say if you can get comfortable with bigger repairs, you're going to have more opportunities. If you see a house, we typically, when we look at houses, we pretty much know if it's going to be about $20,000 of work right off the bat. Now, $20,000 may scare you, but that's usually just like a baseline number for a house that needs cosmetic repairs or need some repairs. So 20,000 is not that big of a deal. You shouldn't be scared off by that. But you're going to see even more opportunity to get a discounted rate if it's going to be $30,000 or $40,000. Like you've got to do a complete gut to one of the rooms for some reason. There's foundation, or there's fire damage or something like that. You're going to get bigger discounts. And then you can increase property value with minimal upfront investment. Minimal upfront investment is really relative. It means that relative to the property, that it's going to be minimal. You're not paying for the whole. You're not paying retail price. So you're not paying $250,000. Maybe you're paying $175,000 and you're putting $25,000 in it. So you got $200,000 in it on a $250,000 house. That would be a good deal. They are out there for people who are patient and people who are persistent. Those are the two qualities you got to have when you're buying properties: persistence and patience. A big one here is just mid-tier suburban or tertiary markets. Now, mid-tier markets are going to be the Austins, the Nashvilles, the major metropolitans, obviously, are going to be Los Angeles, New York, Chicago. Those are the markets. If you start moving down, then you got the secondary or mid-tier suburban markets. Again, like I said, Nashville, Austin. Then the tertiary markets are markets that we love and I love, is because they usually have less than 1 million people in their, in their downtown city or whatever city center. And so you look at places like Chattanooga, Boise, Knoxville, Greenville, Fayetteville. I mean, all of these are great cities. I mean, just think, Knoxville and Fayetteville, two big SEC schools are in here. Now, this doesn't mean you have to do student housing. It does mean, though, that the economy is typically a strong one. These are great schools. Boise, Chattanooga, I mean, these are all fantastic schools and, fantastic markets. There's plenty of tertiary markets out there that you can find. It's going to be a mix of affordability and opportunity to grow some in that market. So I would encourage you, if you can, find one of these types of markets. And then small multifamily. Typically with small multifamily, we're talking duplexes, triplexes, or quads, and it's more affordable for beginners. It gives you an opportunity. It gives an investor an opportunity to do some a house hack if they want to do it. You can get an FHA loan, higher cash flow, less. It's really interesting. There's kind of like a less risk, more risk type of thing. There's less risk from an income standpoint. If you have 4 people paying and 1 person moves out, you've mitigated the risk there, and you're still getting some income versus a single family. However, they're not as liquid as a single family property. You want to sell a multifamily, you're selling it to an investor, and just depending on how the market is, depending on what your pro forma is, there's all kinds of things that go into that. But that being said, it can be done, and I think small multifamily are great properties. I've seen people start out with small multifamily and house hack, or start out with just like a duplex, and then I've seen people start out with single family, move to small multifamily. And we think small multifamily is really anything that doesn't require on-site management. So if you can manage it, if a third party can manage it, or you can manage it remotely, you don't have to have somebody on the property, leasing properties, scheduling maintenance and all that, then those are the smaller multifamily that we like. All right, we're going to jump to number 5. I skipped number 4 after I thought about it. I was like, no, I don't want to include that in the video. I want to skip to number 5 here, and this is owner finance deals or creative strategies. Now, you can negotiate directly with property owners to do owner finance deals where they hold the note. Now, some people aren't going to be able to do that. Some people will if you give them if you give them a down payment, some type of down payment. Sometimes they'll let you assume the loan. Now, I know there are some complications with that, so you just need to make sure everything is above board and you're doing everything the right way. Check the mortgage, make sure that it's assumable. Some of them aren't, but there's different ways you can work around that. I just think owner finance deals, especially if you have somebody who has one of these lower interest rates from a long time ago, and they're just looking to get out from under the property. I had a friend who got a deal not too long ago, and this was the crazy thing is This was an incredible house in close to where I live, actually. So it was a great property, great place, and they had equity in it, but they just couldn't, like, it wasn't ready to be on the retail market. It couldn't be sold on the retail market. And so they just said, hey, we'll owner finance it. They were about to lose the house because they couldn't make any more payments. And so my friend came in and said, hey, we'll owner finance it. We'll take this over and pay you for it. And it turned out to be a fantastic deal. They did a light rehab to the property and then flipped it and sold it and paid the person off. It was a win-win for both people. It was a win-win for the seller and my friend who was a buyer. And then the people who bought the house got a great property. Compared to banks at 7% offering. So I just think this could be a great way, any kind of creative strategy, even if you find a private investor who will loan less than the banks, even if you find a private investor who will loan at 5%, it's going to be better than the 7%, right? So these are some of the creative strategies that you can look at, some of the things that you can do. So that's how I would be looking at real estate here in 2025. If I wanted to, you just have to be very, very patient. And again, you just have to think through different strategies. There's always going to be more than one way to succeed in real estate. And so that's the way I would be looking at it in 2025. Hope you liked this video. Subscribe to our channel. We're going to be producing more investor-friendly content just like this.